yesterday we see the Fed has elected to keep the rate the same, and I want to just talk a little bit about it and help demystify it. So we see the index falling as a result, whether the S&P that fell yesterday or even the Indian index, the Nifty, falling. So let's get into it and demystify it a little bit, because it's important for us to know what the effect of this is going to be, how we need to do our own financial planning, and where would we see the money moving. Like, where would institutions be moving their money, where would like the bigger participants be moving their money in such an environment, and what could be expected in such an environment, right? Let's get into it. So we see this graph right here. We see the Nifty at the top, the Nifty 50, the Indian index, and we see S&P 500. So we see the S&P 500 in the last 2 years, it's just basically remained flat. It's kept on going up and down, more down than up. And we could see it coming a lot lower in this year and later last year because of the sudden interest rate hikes. There were just so many interest rate hikes. You could go to the interest rate hikes video that I had created and look at the trajectory there and the demystification over there. The Indian index continued to grow a little bit more. It didn't fall as much as the Fed. It didn't remain as flat. It grew significantly. If you can see the numbers there, in 2 years, Indian index has grown around 30% or so, and the S&P 500 is basically remained kind of flat. So what we can gauge from this, since there's further rate hikes expected, we'll dive into that in the commentary. What we can gauge from this is when the cost of borrowing is so high, a lot more money we would expect to move into like fixed income sources. This is very important to understand, because a lot of times people say, oh, why is the stock market falling? Like, we bought all these stocks, there's so much value capture left. But the reason is that if you have such high interest rates and you're getting such good fixed income, there would be so much more money in that fixed income. Like, if you get 6, 7, 8%, and now this is in dollar terms, if you're getting close to 10% return on your money, which you never got because the interest rates were just so much lower. But if you're getting that, why wouldn't you pull out and put your money in that safety? You would let the market crash by another 10, 20, 30% and deploy it in stocks when the interest rates go lower, right? Because then the bonds and the fixed income become unattractive. So that's what we see is happening. There's more money probably being moved to that side. And that's why we see this reaction in the stock market. Like, why has it not grown the way it grew in like 2020, 2021? Because in 2020 and 2021, there was just so much lower interest rate. There was a lot more money being pumped into the markets. There was an expectation that we've had this flash crash, we're going to grow sustainably on from here. But then the flip side of that is it grew too quickly. And now the measured approach is being taken, like, okay, let's have sustainable growth, let's tighten it, and let's make sure things are sustainable, and let's get inflation also lower. So this is very important to understand. Now let's go and see like what the Fed commentary is like and what we can expect further. But in Q4, we shouldn't really be expecting too much, because let's say the markets continue to fall for like a week or two, and then we get into corporate earnings coming up in October. We won't really see something that great. Like, maybe there'll be a few outliers, but the industry as a whole, when the cost of borrowing is so high and there's debt on a lot of companies' balance sheets, it is going to hit your cash flows. So as far as the Fed commentary goes, they're going for a soft economic landing. You can just see what Powell has said in the commentary by the Fed. They continue to say this, that they'll go for a soft economic landing and keep tightening the strings. They're also saying they've reduced their own security holdings, so which means probably fixed income is further in play, and that's what they're focusing on for Q4 and the beginning of Q1. So it's very important to understand this. So the markets, like the stock markets and all these other assets where they're borrowing heavy and they're working on borrowed capital to grow their businesses, they're probably going to take a hit because the interest rates are so high. So just keeping up those cash flows, keeping up that growth is going to be difficult. Though also, like what the Fed is saying is that inflation must move down lower sustainably. So that's like the goal that they have, and they wouldn't hesitate to hike the interest rate again in November or December meeting. So this is very important for us to understand, since that's their commentary. That's why the index and the market has sort of fallen and reacted to that, because they are saying that we wouldn't hesitate to hike it again because they want the inflation to come down sustainably, and that is going to result in slower growth in the economy. So for Q4, we may see the indices, whether it's India, whether it's US, whether it's the rest of the world, we're not going to expect too much growth, because such high interest rates, unless you have companies really getting that cash flow, really producing disruptive products, we are not going to see that kind of a growth which we saw maybe in 2020 and 2021. With higher borrowing costs, you also would have hiring further stagnated. You've been hearing of more and more layoffs happening in America, and maybe it's trickling to the rest of the world as well. But we are understanding that efficiency is the primary driver. Growth isn't as big a driver as it would have probably been a year or two ago. Companies are cutting back and tightening how they utilize their resources, how they are hiring, what kind of perks they're giving the employees. So this is very important to understand. This quarter, from October to December, we are going to see some slowdown, and we have to be prepared for that. Fixed income products are going to become more attractive as money is moved there. So that would be a primary focus. So if you're doing your financial planning, if you're thinking where to invest, how can I rotate my money, how can I build up my portfolio, keep this in mind. Like this next quarter, unless you really hit like the jackpot or something, then you would see probably like great growth in a portfolio which consists of securities. But otherwise, fixed income is probably a bigger driver. It is going to be a bigger focus. And over the next few days, weeks and months, let's see how it evolves into the markets, how it translates, and let's see what the bigger institutions have to say about this. Okay, I hope you really enjoyed this video. I thank you for sticking around for this long. Please like and subscribe and spread the word if you learned something from this video. It will help motivate me to create more and more of these videos. And let's see how things play out. And again, as the usual disclaimer is, like, nothing is investment advice. Please study the markets. Please do your own financial planning. Please consult a professional and proceed. All right. Thank you. I'll see you in the next video.